All righty, folks. Given my travel, we have unfortunately not been able to talk with Lance Lambert, Resi Club Analytics, for a little bit. So we're actually going to do a threefer. We're going to talk about Lennar earnings. We're going to talk about buyers and sellers markets by metro. And we're going to close it out with net domestic migration. We've got a lot coming at you. Lance, thanks for doing this. What did you see in the Lennar earnings?
Yeah, housing. There's always so much going on. Thank you for having me on, and it's good to see you back too. Uh,
Yes.
and so yeah, so we've had a lot going on lately. One thing that's been interesting is that to start the year, every year we have these seasonal swings that happen. Coming into the year, you start to see new listings begin to rise as sellers, in particular, the sellers who are planning to sell and then buy something later in the spring. So they want to start early. You start to see the new listings rise. Then you start to see existing home sales rise. Then you start to see new home sales rise. And also all of that kind of culminates or comes together. And by, March through July is when you get the most push upward on prices historically. And that's true in bad years, even when it's like, they go from a lot of falling prices in the second half into kind of, mild, not doing too much. And then in the second half, they give up on prices. Whereas the big years, that's when they see their really big jump. So there's always these seasonal patterns. But what we're seeing this year is that while we have seen the increase in new listings and existing home sales starting its pattern, the new home market, new construction, which has been more resilient for a while, is actually a very muted start to the spring, the early part of the spring. And so Lennar has seen this weakness, KB Homes, both of them have come out and just told investors over the past week that, hey, this is a very slow start to the spring selling season. And I'm going to pull up some of my information here. Give me a second.
Yeah, but while you do that, I actually read both earnings reports, Lennar and KB Homes, and KB Homes' earnings report was ugly. They're talking about price reductions in half the market, which is really interesting. When you think about KB Homes, I think of them as entry-level housing, first-time home buyer. And what I actually did is I tried to compare KB Homes with Toll Brothers, right? Toll Brothers, I would call high-end, right? Kind of the move up, the luxury buyers, and very different earnings reports. But yeah, what'd you get from Lennar?
Yeah. Yeah, so Lennar, which this is the country's second largest home builder, just behind D.R. Horton. They're a very big builder. They're number 126 on the Fortune 500. So they're the 126th largest publicly traded company in America. They are not seeing the pickup that they typically see to start the beginning of the spring selling season. It's off to a soft start. And what Lennar told investors back in December is that they expected greater margin compression this year. And the reason is they were seeing greater weakness than expected. And they were going to pretty much have to do like net effective price cuts or larger incentives to continue to move volume. And they were very clear that they were going to choose volume over margins. So they're pretty much saying, hey, we want to continue to maintain our sales pace. But in order to do so, we're going to have to spend more on net effective price cuts like buy downs. And that's going to compress our margin, but we're going to do it to maintain sales. And that's exactly what occurred. They told investors they expected a decade low Q1 gross margin of 19 to 19.2. It came in at 18.7. So a little lower than they expected. And you can see that's well off the pandemic housing boom highs of 25, 27%, and just a little bit below its pre-pandemic levels.
Lance, correct me if I'm wrong, but wasn't Lennar's CEO the one that said, I think it was 90 days ago, we're going to focus on, quote, pace over profit?
Exactly. That is the quote. Yes. And I have it in here, but yes, we're going to adjust a market and we're going to maintain volume. And yeah, we did a whole segment on it. Yes, exactly.
Okay.
And so what's happened here is that net of incentives, so this is the price net of incentives, is down 1% year over year. And they've said that there's a number of markets where they've cut that. And what does that kind of look like? Well, Lennar last quarter, let me find the numbers here. Last quarter, they spent the equivalent of 13% of the final sales price on incentives. So for a
Wow.
$400,000 home, that translates to $52,000. And historically, they average about 5 to 6% is normal. This comes from John Burns Research and Consulting. You can see 13% is well off where we were at the height of the pandemic housing boom when it was 1.5%. And that's actually the highest since like 09, actually, yeah, late 09 is the highest.
That's not good. That's not a good comparison. Builders don't want to compare to 09.
Now, what is kind of different is that while they've done all these net effective price cuts and bigger incentives, is that their net new orders is actually slightly up year over year. And that's what they did. They chose to compress their margins and maintain the volume. Now, where things get a little interesting is if the market were to weaken further, whatever, it's maybe a recession or whatever happens, right? Actives get higher than they are today and they are growing. Well, what could then begin to happen is you start to reach a point on the margins where the builders might not want to go any further in terms of compressing their margins, right? It makes sense for them to compress margins when they're working off of these historic highs. I mean, their margins during the pandemic housing boom were bigger than they were in the run up in during the housing bubble in the mid 2000s. And so they're making a lot of money. It makes sense to compress. But what becomes a question is, if it compresses too much, does it then begin to eat at activity, right? And so they're like, you know what? We're not going to sell homes below this certain threshold. We're going to want to maintain our margins, and then they would pull back on volume. If that begins to happen, that would be an economic impact, right?
For sure.
But right now, with them doing these bigger affordability adjustments, this does become competition for the resale and existing market, right?
Oh, without question. I mean, when you have home builders taking net margins of hits of 15%, buy downs and all of that, yeah, that is absolutely competition for existing homes. Absolutely.
And it's also opportunity for investors too. I know somebody, and I believe there also might be in your audience as well, that bought some homes from Lennar that they were advertised at, let's say, 320. They paid like 250, 260. Sorry. The homes were 320. They paid 320, but the difference between what they actually agreed upon, the 260, they got back. Because these builders are doing so. The home was 320.
Okay.
They were able to buy it for 260, but they paid 320 and they got the difference back because these builders are trying to maintain comps. And so there are there's areas of opportunities for investors to kind of shake down some of these builders in the place they have more spec inventory.
Absolutely. I mean, you know our story. Olivia and I it was actually Lennar. We beat up Lennar for the house that we live in Vegas. We didn't get quite that big of a discount, but we got everything we wanted and more. So absolutely, folks, today's the time to go to builders, try to get your discounts. If you're in a lucky position where you could buy multiple, I'm sure they would be open to that. But yeah, disrespectful offers with builders, that's okay too.
And when you got yours, you actually got it at a really good time because that was coming out of the weakness that was in Vegas. At that second half of 2022 into 23, they've actually tightened up a bit more on that market. And KB Holmes, CEO, I believe.
He did. The best market in the country.
Yeah. And Inland Empire has been another one when I talk to their CEO, which I get to do an annual call with Jeff, usually around June. Inland Empire is another one that's done really well out in California. And so where I think a lot of this weakness is for the builders, I think it's a lot of these Gulf markets, Texas, some of these Mountain West markets, the places where active listings have moved up a lot. We do have, and give me a second to pull up the chart, we have more let me just get it here. Okay, here we go. So the number of completed but unsold single family new builds is at the highest level since July 09.
Yep.
And I think a lot of that is in these markets like Florida, Texas, because that's where they're talking about the weakness. Census doesn't break it out, but that's where I believe it is. Now, let's say you want to take this chart and you're like, you know what? Let's put it in the context of the country is bigger now than it was like in 05, 06, right?
Sure.
So I have another measure that I do, which is a finished home supply index I created. And this is completed unsold homes divided by the current number of housing starts. And what you'll see is when you do it like that, it reins in some of that jump. Now it is above pre-pandemic levels, but it reins it in from the 08, 09.
Mm-hmm. Yep.
But if we were to hit a speed bump and housing starts were to drop tomorrow 20, 30%, this would spike even if the number of unsold builds didn't increase much. So I do think it's good to still look at both. And again, I think a lot of it is in these markets that are green here that are above pre-pandemic levels.
Well, I'm going to throw you a curveball, and if you don't have this, it's totally okay. But I was just thinking about all this tariff stuff that goes into effect next week. Have you heard about any builders talk about impact of tariff, raising prices, beating up, suppliers? Anybody talking about that?
Yeah. So Lennar talked about it. They said no impact from tariffs yet.
Okay.
And I think Lennar, just given the fact that it is this massive builder, I think they're a really important one to follow here. On Friday, they said, we've been in discussions regarding the potential impacts of tariffs with our supply chain. These discussions all start with a review of margin reductions Lennar has already taken, blah, blah, blah. To date, we have had no impact to our cost from tariffs.
Okay.
And so I think an important word there is yet. We don't know, but that's what they're saying today. In terms of immigration policy, same thing, no impact yet. We do know that a chunk of subcontractors are illegal immigrants, not documented, more so on like drywall installation, roofing, right, painters.
Sure.
But today, there's been no shortage of labor or impact to cycle times. And now some people have pushed back when I've reported this, stating the fact that, well, Lennar doesn't actually directly hire.
Right. They're all subcontractors.
But at the end of the day, when you have such a big perch like Lennar, if it is having a shock there, they're going to feel it on cycle times. They're going to feel it on.
Oh, yeah. They'll feel it first for sure.
Exactly. Yeah. So I don't really support that narrative that's been pushed. I think they will feel it. If it's something, they'll feel it.
No, I think that's great. I'm glad that you're able to stay in contact with the biggest and baddest players on the market. Let's switch gears to buyers and sellers markets by metro. This is very interesting because again, I do think some parts of the country are in a buyer's market. Some are clearly not. Some are still clearly sellers market. So I'm curious, what do you see?
So Zillow has an analysis, and anything that is dark red here, over 70, is a strong seller's market. The Connecticut's, parts of the Northeast, these places that are still down 60, 70% for actives. And that is why inventory is such an important thing to follow. Yeah, mortgage rates are up double where they were a couple years ago, but on the ground, things feel so different across the country right now. And so strong sellers market is over 70, this dark red. This kind of peachy reddish color, this is seller's market. This is kind of like Southern California, some of these pockets out west that have kind of tightened up a bit, some parts of the Midwest. Then you go to neutral market, which is 45 to 55. It's kind of this light purple. You see a lot of this kind of, in the, Sun Belt where there's a lot of new construction. Buyer's market is this lighter blue. Again, a lot of it in the Sun Belt. And then dark blue, which there's not many of, is strong buyer's market. And and you could see it's a lot of where the weakness we've talked about, Florida, parts of Texas, parts of like Louisiana, these areas that had a lot of people moving in during the pandemic housing boom. And they still have people moving in, but it's not like it was then. So then local incomes have to support more where prices got to. And oh, by the way, these places saw more appreciation on prices. So then it becomes a bigger disconnect with local incomes. And then these places also have a lot of new home construction or maybe even multifamily construction. And builders are going to have to move that supply. And builders are on a totally different economics than existing home sellers. And if they need to do affordability adjustments, get creative to kind of pull in buyers, they will. And as they do that, they pull away buyers who would have otherwise went to the existing resale market. So the existing resale market inventory begins to build. And that's what's kind of shifted more of these markets. And so nationally, Zillow puts us at a 54, which is at a little bit of the higher end of the neutral side of a market. Now, what's interesting to look at is I went in and I pulled the data to what we look like in February 2022.
Wow, look at all that red.
Was a strong seller's market.
Yeah.
So I think this is a fun analysis. I'll probably continue to do this every month for Resi Club readers. It'll go out to the free list.
Nice. Well, let's close this out because, again, I think what we're seeing a lot in these charts is about migration. So I'm curious, what does net domestic migration look like these days?
So this is a report that went out to my pro audience, my paying audience. I do this annually. It's looking at net domestic migration. Really important before we go any further. Net domestic migration is not total population change. I'll do that in a separate report. It doesn't include deaths. It doesn't include births. It doesn't include international migration. It is just the number of Americans moving into your market subtracted by the number of Americans moving out. So if you take all the net domestic migration across the country, negative and positive, and you add it all together, it's going to go to zero. So it is actually one of those few metrics that is zero sum, right? Some people are gaining net domestic migration positively, others are losing it. And so when you look at the data, what you will see is that in 2024, on a total basis, a lot of it is the suspects that you get talked about a lot. The Californias, Chicago, New York. Now this is just total number. This isn't percent. Miami's one that doesn't get talked about a lot, but it's been consistently negative net domestic migration for a long time. And a part of that, some of these markets, a part of it is they don't get a lot of people on a net basis moving in that are Americans, but they do get a good amount of net people who are international. That's been the case for New York for a long time, where it's like one of those first stops for a lot of immigrants. And that's been true whether it was the Irish or the Italian, Puerto Ricans, and it continues to be true for each new group that comes into America. And Miami kind of feels some of that as well. So this is 2021, and you'll see that a lot of those Sunbelt markets that are still positive, it was much darker in 2021. There was a much bigger burst. And then this is kind of what it looked like in 2019.
Well, California is a pretty consistent loser in all three charts.
Correct. So if you look here, this is total number. You'll see that Dallas is the biggest still. It's not like it was during the pandemic housing boom, where it had and when it says 2022, the census data is actually July to July. So 22 is July year. 21 to July 22. And in that period, Dallas had 91,000 that moved in on a net basis. Austin had about 40,000. Now they're both still high, but it went from 91 to 24 for Dallas. And for Austin, it went from 37 to 13. And that's what I was talking about earlier about even if you're still positive for net domestic migration, you can still feel a demand shock from the deceleration because a lot of the people who are coming in were from California, from New York. They had money, right? And so when you have fewer of those, that has an impact. But if you go down and you look at the places that have been losing, New York, long time, LA, long time, Chicago, Miami, San Francisco, DC, these have been consistent for a really long time. And it accelerated during the height of the pandemic housing boom. It has since decelerated the rate, but it's still fairly high. Now, those are total numbers. This one now is adjusted for population, and you'll still see that it's still the same suspects that are pretty high. A lot of the country doesn't really see a lot either way necessarily. And some of these faint ones in the Midwest, that's really just driven by the plus 60 crowd moving down to Tennessee, Carolina, South Carolina, Florida, retiring.
Got it.
And that's adjusted for population. Now here's 21. These two are probably the best two maps here. You can really see that during the pandemic housing boom, and again, this is adjusted for population size per 1,000 residents. California had a lot in the big cities. Out New York, a lot. Florida was on fire. Carolina on fire. Texas, so many people moving in during the pandemic housing boom. And you can see it's still positive, but not what it was before.
Mm-hmm. And these charts will, if work from office is a thing and people are returning, this could show a boomerang if that trend continues next
I
year.
think that's what we've seen already, is some of that. And now the boomerang doesn't mean that places like, these places in the South are seeing big net domestic migration losses, negative. It just could mean that the rate of net domestic migration decelerates a lot.
That makes sense.
Like you've seen in Dallas and Austin that I showed. And this is the per capita rate by metro. I do have 16 charts here. I went a little crazy on this one. So this, and we don't have to show them all, but this is by county, the total. And let me get down here. Okay, this is one of my favorite, actually. So this is the same as earlier for adjusted for population, but it's by county instead of metro. Mm-hmm. And here's where we are currently. So still a lot of it's in the Sun Belt, but you can see during the pandemic housing boom, wow, like that was a lot of net domestic migration. Yeah. And when you look at it this way, that's where you could really start to see the Mountain West, like that big boom that Idaho had, where Boise is up 40% year over year for prices in 1 year.
I remember.
Which is twice the record nationally. And you could see now that's really decelerated. And actually, parts of Boise have seen negative net domestic migration. So that is the boomerang effect. They have actually seen outright total declines.
Very, very cool. Well, there's always so much going on in housing. You've been doing an amazing job with Resi Club Analytics. Let's tell people where they should go to subscribe, where do they get the free stuff, and where do they get the paid stuff?
Yeah, so if anybody wants to subscribe, go to resiclubanalytics.com. I have a free list where I send out a few articles a week. I also have a premium list where you get to listen into a monthly webinar I do, 3 additional research articles per week, access to my data trackers, and just a lot more charts and maps. If I also put out a lot of stuff on social, if you want to follow me on LinkedIn or Twitter, my handle on Twitter is, it's now X, @NewsLambert. And if you ever have any thoughts, you can email me at lance@resiclub.com.
There you go, Lance. Thank you for all you do.
Thanks for having me, Zuber.